Hi, welcome to Lecture 11, covering Chapter 11 of Focus on Personal Finance. Today we will be looking at investing basics and evaluating bonds. Well, by this point in the course, I hope that you have decided on your long-term financial goals, or at least have a pretty good idea as to what those might be. You've answered questions for yourself, such as, what do I want to do with my money over the course of my lifetime? Do I want to buy a home? Do I want to buy a vacation home? Do I want to take a vacation of a lifetime? Do I want to retire early? Do I want to put aside money so that I can pay for all of my children's college education? Your dreams and your goals are the driving force behind your investment plans. And the earlier you get started saving, the better your choices of getting there. I'm sorry, your chances of getting there through the choices that you make. So in this chapter, we'll look at the importance of preparing for an investment program. We'll look at how the factors of safety, risk, income, growth, and liquidity affect investment programs. We'll examine the methods that investors can use to reduce investment risk. And included in this section on reducing risk is a discussion on the importance of your role in the investment process. And then we'll end by looking at bond investments. All right, so let's get started. We have 6 goals for tonight, so let's try to keep this moving. The very first goal is objective number 1, explain why you should establish an investment program. After developing your investment goals, you must make sure that your financial affairs are in order. The next step is the accumulation of at least 3 months of emergency fund living expenses. Then it's time to save money that you need to establish an investment program. The time value of money concept can help you achieve your goals, especially if you start saving sooner rather than later. Learning objective number 2, describe how safety, risk, income, growth, and liquidity affect your investment program. All investors must consider these factors. Especially important is the relationship between safety and risk. The potential return for any investment should be directly related to the risk you assume. Choose investments that provide income, growth, and liquidity. Learning objective number 3, identify the factors that can reduce investment risk. Asset allocation is the process of spreading your assets among several different types of investments in order to lessen your risk. Also, the amount of time before you need your money is a critical component. Finally, your age is going to be a factor that will influence your investment choices. Learning objective number 4, understand why investors purchase government bonds. Generally, they are chosen simply because most investors consider them to be a safe harbor in troubled economic times. Learning objective number 5, recognize why investors purchase corporate bonds. So bonds are sometimes issued by corporations in order to raise capital. Investors purchase corporate bonds for interest income, possible increase in bond value, and repayment at maturity. Most corporate bonds are bought and sold through full-service brokerage firms, discount brokerage firms, or the internet. And you need to make sure that you're aware that investors will pay commission when bonds are bought and then also when they are sold. And then learning objective number 6, evaluate bonds when making an investment. Today it is possible to obtain information and trade bonds online via the internet. To determine the quality of a bond issue, you need to study the rankings. Investors can also calculate a current yield to evaluate a decision to either buy or to sell bond issues. All right, let's get started on our lesson tonight. So learning objective number 1, explain why you should establish an investment program. The decision to start an investment program is an important first step to accomplishing those lifelong financial goals that we were talking about at the beginning of this lecture. What are the things that you would like to accomplish in life? Well, you're going to have to start saving and investing in order to make those dreams come true. Your investment goals should be SMART goals. We talked about those early on in the book. And your investment goals must always be oriented toward your future, your financial needs, and your wants. To begin an investment program, you must make sure that your personal financial affairs are in order. So to be successful, you must have a history of paying your bills on time. You must have a balanced budget. You must manage your credit card debt and other debt. You need to start an emergency fund that's equal to 3 months of your living expenses, at a very minimum 3 months. 6 months is ideal. And you need to have a small fund set aside in case of an emergency, or at least a way to be able to access cash should you need it. Now, I'll say that one of the things that I think was the hardest in this plan is the saving of the 3 to 6 months of your expenses and putting that aside so that you have that in case something would happen. But once again, let me just share with you a quick personal story. I mentioned earlier that my husband was laid off in a corporate downsizing after he'd been with the company for 35 years, and it was a huge surprise. I mean, I can't tell you how huge of a surprise that was to us. He had been an outstanding employee, well-known, well-loved, incredible performance reviews for 35 years, and for his name to be on the list whenever they took out, actually it was an entire level of management, and he happened to be in that level. It was devastating to us. And though we had at one point had 6 months of income put back in a savings account, at the point that this happened, we had allowed that to dwindle because we had withdrawn those funds to use on vacation and some other expenses. And so this happened at a time when we were not prepared and really rocked our financial foundation. So you never know what tomorrow holds. So to have funds put back in case you have a job loss or some other type of illness that would prevent you from being able to work is really critical in your financial security. On page 353, there's a chart there that helps you to think through ways to start putting aside money for an investment program. It can also help you to determine what's important to you and what do you value. For most people, the easiest way to begin an investment program is to participate in an employer-sponsored retirement account, often referred to as either a 401k or a 403b account. So if your employer offers that, you certainly want to know the ins and outs, especially if they offer fund matching on that. Most employers do offer a portion match for your contribution. So let's say that you can contribute up to 6% and your employer will match that at 3%, then you're getting a 3% raise, because if you're not participating in that, you're not getting the money. But if you do participate, then they're putting money back for you into your retirement account that if you don't participate, otherwise you don't get. So I highly recommend that you consider participating in any employer-sponsored retirement programs where they have matching funds. It's sad because many people never start an investment program because they feel like they have such a small sum of money to put back that it really wouldn't make any difference. But even small sums of money grow over a longer period of time. So the earlier that you get started, the better chance that you have of your money working for you and you being able to meet your financial goals and dreams. In your book on page 354, there's a figure it out exercise that I hope you take the time to work through. This little exercise can help you to see how different investment returns can affect the total amount of money that accumulates over different periods of time, and helps you to see how time value of money can really work in your favor. As you work through this exercise, notice that the investments earn a higher rate of return that those that do, that the portfolio value increases dramatically. So it does make a difference what the interest rate is that you're earning on your funds. So the search for higher returns is one reason many investors choose stocks and mutual funds that offer potential higher returns compared to what, like a CD or what you can get with a savings account, especially in today's economy. So learning objective number 2, factors affecting the choice of investments. The safety and risk factors are really just two different sides of the same coin. Safety is an investment. Safety in an investment means minimal risk of loss. On the other hand, risk is an investment in an investment means a measure of uncertainty about the outcome. So in looking at investments, they range from very safe to very risky. At one end of the investment spectrum are very safe investments that often attract conservative investors, and that would be me. I'm a conservative investor. I get a little bit scared if there's too much risk involved, and I like something that's a little bit more conservative. Though I don't always like the trade-off of getting smaller earnings, I feel better about the idea that there's less chance that my investment would become worthless. At the other end of the spectrum are those that like very risky investments. That would be my husband. So the speculative investment is a high-risk investment that is made in the hopes of earning a large profit in a shorter amount of time. And though they offer the possibility of a larger dollar return in a shorter amount of time, if they're unsuccessful, you can lose most or even all of your investment. So you need to know what your risk factor is, and for those that are highly speculative, you need to be really careful about investing in those. There's a reason that the trade-off is so much in favor of a high return, and the higher your return, then the more chance that you could also end up with nothing. So you need to figure out what your tolerance is for risk and how that compares to what it is that you want in safety. Find your balance and go for that. And my husband and I have come to terms by saying, okay, on this account, these funds, we're going to be have a little bit higher risk, and over on these, we're going to take a lower risk. And then whenever I get those statements and I see how little my money made compared to what his made, then sometimes I get frustrated with that. But then there have been times when the market has been off and I've made money and he's lost money because his investments are in higher risks. So you just have to kind of figure out where you want to be and how you want to play the game, and then get in the game. And then my advice to you is stay there, because only through staying in there over a longer period of time do you have the chance to recover anything that you've lost if you're in a higher risk market. Factor associated with investments does change from time to time. In fact, we can look at the overall risks by breaking it down into 4 different components: inflation risk, interest rate risk, business failure risk, and market risk. So the first one is inflation risk. So during periods of high inflation, it's always possible that the money that you have invested may not make enough in earnings to keep up with what inflation has done to the dollar. So that's one risk. Interest rate risk. Interest rates are always going up and down, and the value of a bond or a preferred stock may increase or decrease with those changes. There's always a possibility that the business that you've invested in would fail. Market risk. So economic growth is not as systematic and predictable as sometimes we think that it is as an investor. So generally a period of rapid expansion is followed by a period of recession, and you need to be careful whenever you're writing the business cycle as to what's happening in our economy and how that can impact your returns. Investment income. If having a predictable source of income is your goal, you may want to look at CDs, passbook savings, or government securities. Other choices that we'll talk about are municipal bonds, corporate bonds, preferred stock, utility stock, and select common stock. You can also look at mutual funds or rental real estate. So to investors, growth means that their investments will increase in value. Common stocks are often considered to be the largest growth, have to offer the largest growth potential. Mutual funds and real estate rental properties are also good, strong growth potentials. You need to know what the liquidity of your investments are. And just as a review, liquidity is the ability to buy or sell an investment quickly without substantially affecting its value. So in addition to being able to sell it quickly without affecting its value, You also need to consider whether or not there's going to be expense in liquidating, such as if you have rental property and you have to pay a real estate agent a percent, which is usually 6% to sell your property, then you're going to have to consider that in how liquid an asset might be. So learning objective number 3, factors that reduce investment risks. Okay, this is where I live, right? I like to reduce the risk as much as possible. So let me share this fact with you to kind of help maybe bolster your confidence just a little bit. Since 1926, which has been over 90 years now, stocks have returned an average of almost 10% a year. During the same period, U.S. government securities earned just over 5%. So before making a decision to purchase stocks, consider the factors of asset allocation, the time your investment will work for you, and your age. Once again, time is on your side if you start early and leave your investments to grow. So the best way to reduce your investment risk is through allocation and diversification. Asset allocation is the process of spreading your assets among several different types of investments in order to lessen your risk. So I'm sure you've heard the saying, don't put all of your eggs in one basket, and that would be applicable here. So for example, you might want to invest 40% of your assets in stocks, and then 30% in mutual funds, and 30% in a certificate of deposits and bonds. The diversification provided by this gives you a measure of safety and reduces risk, because a loss in one type of investment will usually be set off by gains in one of your other types of investment. Now for you personally to decide how much of your money you want to put in each asset group, you need to consider certain factors such as your age, what are your objectives, how much can you save and invest each year, the dollar value of your current investments, what's the economy look like, and what's the projection of the economy, and several other factors, such as how much time you have for your investments to work for you. You can leave your long-term investments alone for, let's say, 5 to 10 years and let them work for you. Then you can invest in stocks and mutual funds. On the other hand, if you're going to need your investment money in like 2 years or less, maybe you're saving for the down payment of a house, you should probably invest in something like short-term government bonds or highly rated corporate bonds or certificates of deposit. A final factor to consider when choosing an investment is your age. Younger investors tend to invest a large portion of their assets in growth-oriented investments, while older people, such as myself, tend to be more conservative. So there's a financial expert, Suze Orgman, and she suggests that you subtract your age from the number 110, and the difference is the percentage of your assets that should be invested in growth investments. So that's probably a pretty good factor. And then the older you get, the less your tolerance for risk. Number 4, conservative investment options. Let's look at government bonds. Investors often consider government and corporate bonds to be safer when compared to stocks, mutual funds, and other types of investments. And they're also a great way to diversify your portfolio. Bonds. So government bonds are a written pledge of a government or municipality to repay a specified sum of money along with interest. You can buy federal bonds, state bonds, or local bonds. You'll find this chart in your book on page 366. It gives you specific information about each type of the U.S. government securities, and it might be worth your time to take a minute to just look through that to see if what the differences are and if there's anything here that might interest you for purchasing. Investors can also choose a municipal bond. Say that 3 times fast. A municipal bond is issued as a debt security by a state or local government, such as a city or a county or even a school district. And then the funds are used for costs depending on what was specified in the bond, but such as building a new school or major repairs at a school, to build a local airport or a bridge repair. There are two different types of municipal bonds. The first is a general obligation bond, and this is a bond backed by the full faith, credit, and unlimited taxing power of the government that issued it, where a revenue bond is a bond that is repaid from the income generated by the project it was designed to finance, such as if you're building a bridge, maybe the bridge that you were building was a toll bridge, and as tolls are charged to people using the bridge, then those funds are used to repay the revenue bond. If the risk of purchasing a municipal bond worries you, you can purchase what's called an insured bond. I'll also note here that one of the most important features of a municipal bond is that the interest that it earns may be exempt from federal taxes. And because of the fact that they're most likely exempt from taxes, their interest rates are usually lower than bonds that are taxable. Number 5, we're going to look at corporate bonds, which are also considered a conservative investment option. A corporate bond is a corporation's written pledge that it will repay a specified amount of money with interest and is considered to be safer than stocks. The face value is the dollar amount that the bondholder will receive at the bond's maturity. The face value of a corporation's bond is usually $1,000. Between the time of purchase and the time of maturity, the corporation pays interest to whoever holds the bond, usually every 6 months. And the maturity date is the date of which the corporation is supposed to repay the borrowed money. So maturity dates for bonds generally range any place between 1 year and 30 years. So you might ask yourself, why would a corporation sell bonds? Well, corporations sell them to pay for major purchases or to help financing for ongoing business activities. Some of the reasons that they might do that is if it's difficult right at that point to sell stocks. The sale of bonds can also improve a corporation's financial leverage. And finally, there is interest that's paid out by the corporation on those bonds, and that is tax deductible for the firm. There are a couple of different types of bonds that a corporation can choose to sell. The first is a debenture bond, which is backed only by the reputation of the issuing company. And that might be a little scary for some of us. So corporations can also issue a mortgage bond, and this is secured by various assets of that corporation. However, once again, you have that risk trade-off. Because you have less risk in purchasing a mortgage bond, normally the interest that you're going to earn is a little bit lower. Convertible bond is a bond that can be exchanged at the owner's request or option for a specified number of the corporation's common stock. So interest rates on these types of bonds are usually lower when compared to traditional bonds. If you are in the market for a higher interest rate, if you would like to earn a higher interest rate than these other options, you can purchase what's called a high yield bond. Sometimes these are referred to as a junk bond. It does pay a higher return of interest, but there's also a much higher risk of default. Today, most corporate bonds are what is called callable. A call feature allows the corporation to call in or buy outstanding bonds from current bondholders before the maturity date. From having your bond called for the first 5 to 10 years after it's been issued. And the reason why a firm would want to do that is if they are paying out a higher rate on that bond than what is the current market rate. So they would do that because they can't earn money in their investments as high of a rate as what they're paying out to you for owning that bond. So they're wanting to get that off the market and stop that bleeding. To purchase a corporate bond, well, corporate bonds may increase or decrease in value up until their date of maturity. And the changes in the overall interest rate in the economy are the primary driving force of most bond price fluctuations. So if overall interest rates fall, then the corporate bond with the fixed rate will go up in value. On the other hand, if the overall interest rate rises, then a corporate bond with a fixed rate will go down in value. So the overall financial condition of the corporation, just simple supply and demand, the upturn and downturn of our economy, roller coaster that we ride, and the bond's maturity date will also affect the value of your bond. So corporate bonds are repaid at maturity, and when you purchase a bond, you have one of two choices. You can either keep the bond until maturity and then redeem it, or you can sell the bond at any time to any other investor. And most bonds that are sold through full-service brokerage firms or discount brokerage firms or on the internet. And we're seeing more and more people buying and selling on the internet. Generally, if you purchase a $1,000 bond through an account executive or a brokerage firm, you can expect to pay between $5 and $25 commission on that sale. So you have to consider that in what that bond is costing you. If you purchase more bonds, you can usually drop that commission rate to between $1 to $10 per bond. You need to be aware that you're also going to pay a commission when you sell the bond. Close with learning objective number 6, which is to evaluate bonds when making an investment. So one basic principle that we've stressed throughout this entire lecture, actually throughout this entire book, is to evaluate any potential investment. Certainly corporate and government bonds are no exception. You can find information on the internet simply by accessing the corporation's webpage and locating topics like financial information or annual report or investor relations. As you review this information, it should give you a strong feeling for what the financial strength of the company is. When investing bonds, you can also use the internet to obtain price information. You can use it to actually trade the bonds, and then to research bonds by accessing bond websites. In your book on page 374, you'll find this chart, and this helps you to look at different types of bond ratings. Bond ratings will help you to determine the quality and the risk associated with that bond issue. Two of the main companies are Moody's and Standard & Poor's. Standard & Poor's bond ratings range from AAA, which is the highest, to D, which is the lowest. And for Moody's, they use AAA, which is not all capital, first A capital, then the rest are smaller, which is the highest, to C, which is their lowest. And the rating of U.S. government securities and state and local government securities are similar to that of corporate bonds. Look at how to calculate the yield on a bond. So a bond's yield rate is determined by dividing the annual interest amount by the bond's current price, and that's going to give you the current yield. This calculation allows you to compare the yield on a bond investment with the yields of other investment alternatives. Investors can also use a couple different resources to give you good potential bond investment information, and these are listed on this slide. Business periodicals can provide information about the economy and interest rates and detailed financial information about corporate and city entities that issue bonds. And then a number of federal agencies provide information that may be useful to bond investors, and they're here on this slide as well as in your book. Well, it's my hope that this lecture helped you to think about some different investment opportunities beyond just CDs and savings accounts, and how you can find your tolerance and invest in some different things that will help you to have some diversity in your investments and help you to get to where you want to be in the long run. As always, the slides full deck is posted for your availability, and there's also some supplemental videos that have been posted. I hope you'll take a few minutes to look at those. If you need me, you can get a hold of me through the information listed on our syllabus. And I'll look forward to speaking with you all again next week.